I wanted to start the day today with, as Monty Python used to say, something different. And now for something completely different, for those of you who used to watch Monty Python. 40-something years ago, Steve Harbeck and I were neighbors in Burke, Virginia. We were young 20-something-year-old lawyers. I was at the OCC. Steve was, I think, just starting at SIPC then.
Yeah, just starting at SIPC.
Just starting at SIPC. I think you were sweeping the floors, right?
One level above.
Right, okay. And we used to celebrate Christmas together. We had eggnog parties and things like that, which I won't go into. But little did we know, all those years later, Steve would be the person at SIPC, the president and CEO of SIPC, handling the Bernie Madoff scandal. And years later, I would handle the savings and loan crisis. And as I've now found out, become the human being who's closed the most financial institutions in this country since the Great Depression. That's an honor I don't wear a lot, and I hope I don't have to hand it off to somebody else, because that will mean we will have had another crisis. But we closed 1,500 savings and loans in the early 1980s. And so I thought a lot about history and institutional knowledge, particularly when I was writing my book, 200 Years of American Financial Panics. You realize the importance of history, because everything repeats itself. We just repeat the same mistakes over and over and over again. And we keep replicating the institutional knowledge that we keep losing as people filter through the government. It's a highly inefficient process, but unfortunately it's the best one we've got. And so what I wanted to do this morning is focus on history a little bit. Focus on how we get to financial crises, how we get to financial scandals, and how we can prevent them, because there's no doubt in my mind we're heading towards another one. The only question is, what's the trigger that blows off all the financial IEDs that are being embedded in the economy as we speak? And so what I want to do is focus a little bit here, both on macro and micro financial problems, and just share with you some of these stories about how things have happened in the past and how they were resolved. When I got to the Federal Home Loan Bank Board in 1981 as a 31-year-old lawyer and was sworn in as general counsel, I didn't know which end was up, for sure, until they came into my office and said, all 4,500 savings and loans in the country will fail within the next 24 months. And I said, well, that's great news. And you learn fairly quickly. The one question I always had in the back of my mind was, how did this happen? I didn't have a lot of time to think about that question when I was there, but I thought about it a lot afterwards, and you realize how it happened was horrible government policy. It wasn't executives, it wasn't greed. They were forced into a position which was essentially borrow short at 5.5% and lend long 30-year fixed rate mortgages. Remember, in the 1970s and 80s, savings and loans could do one thing and one thing only: make a 30-year fixed rate mortgage, right? So we locked them into borrowing short and lending long, and guess what happened at the end of the Carter administration and the beginning of the Reagan administration? The prime rate went to 21%. That formula can't work. It just can't work. Therein lies the problem why literally 3,000 savings and loans have disappeared since that time. And so what I wanted to do is sort of focus on those kinds of things and pick Steve's brain with respect to the whole Bernie Madoff scandal, because it was one of the most fascinating periods in the history of this country, I think, by any stretch of the imagination. So Steve, let's start with a very simple question. What does SIPC do, and how does it function when problems arise?
Most of you have brokerage accounts, and at the bottom of your statement, either online or on paper, it says members SIPC, S-I-P-C. SIPC's not a government organization, but it was set up by statute. And the one sentence that you would need to know about what SIPC protects and what it doesn't protect is this. And you could sing it, actually. SIPC protects the custody function that brokerage firms perform. If you say that to yourself 3 times, you'll know everything you need to know. But what it doesn't protect is against a loss in value, even if that loss in value in a particular stock in your portfolio was from fraud from the get-go. If you agree to buy something, if it goes up, SIPC's obligation is to return the security to you. If it goes down, you're stuck with the loss. This became particularly acute when so many brokerage firms were pumping IPOs that had no value, and the brokerage firms then failed. Everyone got the stock they were entitled to. But they also got the apple they were entitled to if that went up. So that's the nature of the protection, and that one sentence is what you need to know.
Okay, so you spent, what, 10 years on Madoff?
It's still going on.
Right.
Madoff failed in 2008. All of the American litigation has been resolved, but there's still a couple of $1 billion being chased in Europe.
So one of the things that I took note of closing all those savings and loans is that personalities play a big role in these things. What can you say about Bernie Madoff's personality?
Well, he was a personality indeed, but he was what I would call a sort of an extraordinarily intelligent sociopath. And here's how, I'll give you two examples of how he was a sociopath. One is the people who he stole money from. He stole money from Elie Wiesel, the Holocaust survivor from Auschwitz. He stole money from the American women's Jewish charity Hadassah. He stole money from Sandy Koufax, for God's sake.
Well, once you get to baseball, you got to draw the line.
And sometimes you draw it in Venezuela. But the one thing, that's an example of individuals, but I want you to assume that I'm Bernie Madoff sitting at my desk, and you are on the other side of the desk either giving me money or saying you wanted to take it out. If you wanted to take it out, I would tell you, well, sure, you can take your $2 million out, but I'm not sure I'm going to let you come back in. But the one thing that you would see when you were looking at me is the windowsill behind my back. On the windowsill, there was a sculpture 3 feet tall. It was a giant crooked screw. So when you were talking to Bernie Madoff, you were looking at and getting a giant crooked screw. There's a sociopath for you. Now, by the way, we sold that screw for $30,000. But that's the kind of person he was.
All right, so how much did he steal? What was at stake here in this whole thing?
Well, let's talk about the numbers. The people thought they had $60 billion deposited with Madoff based on the statements they were receiving on dot matrix paper in 2008. But on a money in, money out basis, they had put in $17 billion. On the day we took over and walked into his office, he had $300 million. The results of the litigation have been extraordinary. By suing people who took out more than they put in, whether they had knowledge of it or not, under the preference and fraudulent transfer statutes of bankruptcy, and by going after people who did in fact know about the case, or know about the fraud, the trustee's been able to recover $14 billion and distribute 14 of the $17 billion of the monies that actually went in.
So I want to drop a footnote here for everybody who's in the room and is watching online, because one of the things you learn when you close financial institutions or you deal with the liquidation of a financial institution, the FDIC is very, very well aware of this, is money is always moving, right? It's always in movement. So when an institution fails, the money may not be there that somebody thinks is there. It may be moving to that institution. It may be moving from that institution. And then you have all of the various laws that apply under NACHA, holder in due course, the Uniform Commercial Code, all those things that lawyers get, dizzy over when these things happen, because everything's in motion. We tend to think about these things in a stable form, but the fact of the matter is everything's always in motion. Now, what I want to drop here in terms of the footnote for later is think about how that issue affects tokenization of everything that moves in the market, right? Tokenized deposit, tokenized the securities. Are they really the security? Are they really the deposit? So, Steve, how could any of this been prevented? I mean, could somebody have stopped Bernie Madoff at any particular time?
He could have been stopped with one phone call to the National Securities Clearing Corporation. If anybody had picked up the phone, and for those of you who remember Bob Newhart doing half of a telephone conversation, the conversation would have gone like this. Hi, this is the National Securities Corporation? Yeah, are you? Can you tell me how many shares of Apple stock you're holding for Mr. Madoff's customers? 400, okay, 400. 400,000, not 400,000, 400? He just managed to steal money, and perhaps describing how he did that would be helpful here. Knowing how Bernie Madoff stole his money is as easy as remembering the movie Back to the Future 2. Okay? In Back to the Future 2, Biff, the fellow who was always covered with horse manure, found a sports almanac from the future and made bets that he discovered were absolutely accurate. Bernie Madoff made up his own sports almanac of trades every single month. What he did was at the end of any month, let's say the 26th, 27th, 28th, his coterie of 6 Confederates that worked with him would look back in the month and see, let's find 5 stocks that went up this month. They would then write up false confirmation slips dated the 1st, 2nd, and 3rd of the month saying we bought at X, and sales confirmations at the end of the month saying we bought at X plus $3 a share, and sent those out to the customers. So he sent out these false statements month after month, year after year, decade after decade. And so you can remember, for cocktail purposes, you can tell people how this was done by analogizing it to Biff and his sports almanac.
So what did Bernie do with the money?
He spent it lavishly on himself and his family and whatever. And he led a lavish lifestyle that made everybody believe he, in fact, was wealthy. He said he was using a split strike conversion strategy, which is gibberish for nothing.
Yeah, I've represented some of those guys.
Yeah, and there is no such thing, and he was doing it in the method that I've just described.
Yeah. So about a month ago, I live in Sarasota over the winter, and about a month ago I was having lunch in a famous deli in Sarasota called Wolfie's, and at the table next to me was Bobby Bonilla. And I didn't recognize him because he's about 6'4", but now he's about 280 instead of 200 pounds. He looks like a football player, just an amazingly huge guy. And he was sitting there happy and signing autographs and talking to everybody that came in. And I understand he's part of the Bernie Madoff story.
We know why he's still so happy. Bernie Madoff had somewhere in the vicinity of 15 or more accounts associated with the New York Mets. If you were on the pitcher's mound at Shea Stadium, Bernie Madoff was sitting here. Katz and Wilpon, the 2 owners of the Mets, were sitting on either side of him. What they did is they told, among other people, Bobby Bonilla, let's throw away your then extravagant $6 million a year contract, okay? And we'll pay you, this is way back in the early 2000s, we'll pay you $1 million a year every year on July 1st until 2035. Those are valid contracts that he had with Bobby Bonilla, and what they would do is take the $6 million, and Bernie Madoff would turn it into, on paper, the false profits that they then took out and spent on themselves. Through the process of discovery, we discovered a phone call, notes by one of the 2 owners, to his insurance agency, and the notes were in his own hand. And the note said, hi, again, let's do the Bob Newhart thing to the phone call. Yeah, you're my insurance agent, Al? Yeah, okay. Listen, we lost money in a Ponzi scheme a long time ago. Do you write Ponzi scheme insurance? And, oh, that's too expensive. We won't buy that. And so Bobby Bonilla is still making those every July 1st. He's lifting a bottle of champagne to the deceased Bernie Madoff.
Yeah, he looked like a pretty happy guy when he was having lunch.
He'll be happy till 2035.
All right, so you're a regulator, right? And you say to yourself, what are the lessons I should have learned from Bernie Madoff today?
Well, the problem we face now is that he's small potatoes doing a rather simple procedure. There hasn't been a failure of a brokerage firm requiring SIPC to intervene since approximately 2008. There were two of them worth $1 million each in the early 2000s,
So does that mean that they're good at hiding the problem, or there isn't a problem?
I think the problem has essentially been solved by sound regulation. The problem we face now is the regulation can't keep anything close to the pace of the innovations made by money launderers, particularly in the crypto space.
Yeah, so I've said this many times and I've written this many times and I still don't understand the answer, but you know, we are out there cheerleading for crypto and stable coins. And
Who's we?
Well, you know, we'll put that aside for a second. We'll just drop that. And I don't know that consumers are out there part of that we. I don't see any consumers saying, I got to have a stable coin. But the problem is that if you look at stable coins, 70% of the transactions with stable coins are to clear cryptocurrency transactions, right? Because you can't do it with the cryptocurrency because the value is changing all the time. And so I say to myself, why is it that we're struggling to create something to help cryptocurrencies whose highest and best use as a payment instrument is to finance crime? It doesn't make any sense to me. And it's financing crime on a global basis that is astounding. There's a terrific book by Andy Greenberg, who writes for Wired, called Tracers in the Dark. And if you want to read a book, don't read it before you sleep at night. It just will scare you to death. Andy talks about two or three things. One of them is the takedown by federal agents of the Silk Road online, which was the main way that drugs were being moved around the world. And the last part of the book, which is the scariest part of the book, is about the takedown of Welcome to Video. Now, nobody in this room probably knows what Welcome to Video is, and that's a good thing, because Welcome to Video was the largest purveyor of child pornographic materials on the planet, right? They had videos of children as young as 1 year old, right? And it took 3 to 4 years for agents to take down these sites and find these people. And what was Welcome to Video? At the end of the day, Welcome to Video was two guys in South Korea, a father and a son, with one server in the basement with 250,000 videos on it. And how did it operate? How was it financed? It was all cryptocurrency. It was the only way you could buy it.
Well, consider the difference between Bernie Madoff and his 6 associates and the battalions of North Koreans who are scattered all across the globe, whose sole function is to steal money at every single level of the crypto space. And the problem I have is that somewhere there's probably a laundry list of prices for pardons for cryptocurrency actors.
Yeah, right. One of the things I wrote in my second book, The Unhackable Internet, which I can't claim responsibility for, the quote, I got it from people like Richard Clarke, who was the cyber czar in 3 administrations in this country, and other people like that. But the fact of the matter is that we are creating cyber vulnerabilities twice as fast as we are creating solutions. That says to me that we ought to be very, very careful about what we're injecting into the mainstream of the financial services lifeline in this country. Because to the extent that we inject something that will disrupt the stability of that system, we're playing with fire. And I think right now we are playing with fire because I don't think we're thinking enough about the long-term implications of what we're doing.
I agree wholeheartedly, and the only thing you have to look at is the Wall Street Journal every day and this week. An example is that MasterCard is spending $1.8 billion on cryptocurrency. Real estate transactions are starting to become tokenized. Every single aspect of finance that had been separated from the crypto space is now being intertwined with it, and there doesn't seem to be any regulatory appetite to change that. In fact, most of the regulators currently dealing with this are saying the marketplace will take care of it, and there's no need for regulation.
Right. Well, I sort of liken this to 1966 in terms of the crisis I know. In 1966, Congress, with all good intentions, put savings and loans under Regulation Q, and the Fed then put out the Regulation Q limitation of 5.5% on deposits. What was the purpose of that? The purpose was to keep costs down at savings and loans so they could make mortgages more cheaply. It was a way of using savers to subsidize home borrowers. Again, a fabulous goal, right? Let's get more home ownership in this country. Now, we know every time we've tried to do that, it's resulted in some sort of crisis. And I guess you might conclude everybody shouldn't own a home, and that's not necessarily the right goal. But in 1966, that's what Congress did. It put savings and loans under Regulation Q. It took 15 years for that decision to ripen into the fact that 3,000 savings and loans failed largely because of it.
Well,
right?
let's pull up now the fact that the primary regulator for much of the crypto activity is the CFTC, which is far too small an entity and is too much focused on the traditional commodities world to deal with the explosion of activity in cryptocurrency.
So why do we have an SEC and a CFTC? Shouldn't they all be one?
That's a debate that's been going on since 1930, since before you and I were born. There's no excuse for having separate entities deal with crypto, with commodities, with the other thing. The one thing I'm concerned about is cross-collateralization of a commodities account with a securities account with a crypto account. The possibility of, well, let's put it this way. If I were starting a financial company right now, I would start a cryptocurrency company that does prediction markets on third-grade soccer games, okay? And all of those things are under whose regulation? You know, I don't know.
So we're going to open this up to questions. I'd like people to take themselves to the mics, but I've got one other question for Steve, and that is, so you raised the prediction market as one of the next problems. I've been playing senior baseball for 30 years. All of the guys on my team are constantly watching Game Changer. Game Changer is a live, update of what's going on in your kid's baseball game, pitch by pitch, right? So everybody's playing on my team in my game, watching their kids play on Game Changer. And the next thing I could see is people betting on Game Changer.
Well, yeah, the fact of the matter is, you can make those kind of bets in the prediction markets. Now, Tom writes books, and he takes the time to do a lot of research. I write short, quippy articles, and the last one I wrote was on prediction markets. In Kiplinger, if you Google Harbeck and Kiplinger, you can pull it up. It's, should your brokerage firm be your bookie? And the answer overwhelmingly in the space of the people you're talking about is, oh yeah. I want to cross-collateralize my account on prediction markets with my pension. And that's not perhaps the most solid idea in the world.
Okay, questions? Anybody? Paul.
So absent from the discussion was commentary on where were the gatekeepers in Madoff. I mean, you know, where was the SEC? They obviously, forget about regulation, they have an examination function. Where were the public accountants? So could you comment from that perspective in terms of, where were the gatekeepers?
Sure. Bernie Madoff's account was in a second story above a shopping mall, and it was a one-man shop. He went to jail. The SEC appeared before the House and Senate banking committees and what have financial services committees, and there were 8 of them. An academic from George Washington, one of the Georges on, and me on the other end. The 8 people in the middle were fired within the first 3 months of the Madoff saga. Madoff ran NASDAQ. He was incredibly well trusted. He acted like he knew technology. He was just completely trusted. No one challenged him. There's a coffee mug that has under the glaze, Securities and Exchange Commission, Bernard Madoff. He was that close to them that they never looked past him.
Did Madoff ever show up at Epstein's Island?
No, I don't think so. It's about the only thing he didn't do.
Right.
He was very solicitous of his female clientele, let's put it that way.
Question.
Another question on Madoff. When he first started, he was running this other firm, and everybody thought that he was brilliant because he was running, because he saw all of the trades that were coming through before anybody else, and therefore he was using that information to be able to make all these wonderful investment decisions. When he first started, he was only taking a couple clients' money. And what I've never been able to figure out is when he started, was it a Ponzi scheme at the beginning, or did he have good results for a couple years with just a few clients, and then he lost money, and then it became a Ponzi scheme?
As far as I know, it was a Ponzi scheme from day one. He never made the trades. He invented the split strike conversion strategy and told people, I can't tell you how it works because then everybody would do it.
During the Madoff crisis, what was the earliest signal that the system, not just one firm, was at risk? And do you see similar signals today in areas like private credit or fintech platforms? We've recently seen First Brand Group using hidden leverage.
Well, Madoff was not a situation where he individually could affect the entire financial system. Madoff failed in December of 2008. The entity that could have brought down the whole system was Lehman Brothers, and went down in September of 2008. The systemic mortgage problem that brought Lehman down and many other firms was the best financial services movie on earth is The Big Short. That movie tells you all you really need to know about how to bring down a financial system. And is cryptocurrency as big as the mortgage crisis? You bet it is.
All right, one more question. And then we'll let Steve get back to retirement.
Regarding the digital assets, with stablecoins under OCC and NCUA jurisdiction and potentially SEC, CFTC, do you see advantages of that going in where the regulators can actually examine and go in where previously they did not have that jurisdiction? And so because there's argument that the digital assets are a little too far, they're not going away, so there's advantages of regulating them.
They're not going away, but I don't know that the regulators have the depth of talent to keep up with every single nuance that comes around. If you assemble an aggregate group of experts on cryptocurrency, some of them know this aspect of it, some of them know that aspect of it, and I'm not sure that there's a regulator that can put their arms around the entire thing.
No, I agree. I mean, they've made some with the crypto task force, the SEC, and the memo of understanding. They're definitely making a lot of headway, and I think there was not a lot of understanding with the mortgage-backed securities before the financial crisis, with Wall Street.
So it's an interesting point, Steve, that you make, because When I was writing my book on financial crisis, I came across a report put out in 2017 by the Bank Policy Institute that said that it was the view of most people in the industry that the multiplicity of agencies putting out inconsistent and contradictory statements about technology and all this stuff was actually hurting the market rather than helping the market, which raises an interesting question about the future of regulation. And they said, we question whether the bank regulators should be the technology regulators.
But I don't see how you separate the two. You can't. If you don't know the technology and how it works, you can't regulate it.
Right, because technology is going to be an incremental part of safety and soundness. I just don't think the regulators yet have caught up.
Yeah.
All right, well, let's thank Steve for, I think, a very interesting half hour.